Welcome to StokTok's deep dive into Coca-Cola. Coca-Cola is the world's largest beverage company, generating revenue through the production, marketing, and distribution of non-alcoholic drinks across more than 200 countries. At the time of recording, Coca-Cola was trading at $76.63, positioned within its 52-week range, which ran from a low of $65.35 to a high of $82. The Relative Strength Index, a technical momentum indicator on a scale of 0 to 100, was reading 53.2, indicating neutral positioning, neither overbought nor oversold. The stock was trading above its 50-day moving average of $77.06, but well above its 200-day moving average of $70.97, suggesting a constructive longer-term trend. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Coca-Cola operates one of the most recognizable consumer brands in history, built on decades of brand equity, global distribution infrastructure, and pricing power in a category where consumer spending is relatively inelastic. The company generates revenue through a diverse portfolio of beverages, from flagship carbonated soft drinks to water, juices, sports drinks, and ready-to-drink teas and coffees. The competitive moat here rests on brand loyalty, massive scale advantages that drive unit cost economics, and the sheer difficulty for any competitor to replicate a distribution network spanning more than 200 markets. Our StokTok score for Coca-Cola is 45 out of 100, which signals caution. Breaking that down across 5 dimensions. Valuation ranks 0 out of 20, indicating stretched pricing. Financial health scores 15 out of 20, moderate and serviceable. Profitability earned 16 out of 20, reflecting strong margins and returns. Growth scores just 6 out of 20, reflecting slow expansion. And smart money positioning scores 8 out of 20, suggesting institutional conviction remains mixed. Now, valuation. The question every investor has to answer: are you paying the right price? Coca-Cola trades at trailing 12-month price-to-earnings ratio of 24.91, which sits in the upper range of historical multiples for mature, slow-growth consumer staples. The forward price-to-earnings ratio, looking ahead 1 year, is 23.49, a slight compression but still elevated. The price-to-earnings growth ratio, calculated by dividing the price-to-earnings multiple by expected earnings growth, lands at 4.01. For context, a PEG ratio above 2 suggests the market may be pricing in growth expectations that are difficult to achieve, and at 4.01, this warrants caution in our view. The enterprise value to earnings before interest, taxes, depreciation and amortization, or EV over EBITDA, stands at 19.13, which is also elevated for a mature beverage company. The price-to-sales ratio is 6.81, reflecting premium valuations across the entire earnings power of the business. GuruFocus Value, an intrinsic valuation model that aggregates multiple methodologies, pegs the fair value at $68.41 at the time of recording. The stock was trading at $75.74, implying a negative margin of safety of 10.7%. which means the market is currently asking a premium of about 11% above the model's calculated fair value. Wall Street analysts, at the time of recording, have a consensus mean price target of $84, with targets ranging from a low of $71 to a high of $90 across 23 covering analysts. That consensus would imply upside to the target, though considerably less than the valuation metrics would suggest is warranted. The next earnings report is due April 28, 2026, with the street expecting earnings per share of approximately 0.81, with estimates ranging from 0.79 to 0.82. Coca-Cola's competitive moat in brand and distribution provides genuine pricing power, and this translates into sustained margins. Yet the market appears to be pricing in optimism that requires execution. From a sector perspective, global beverage companies have historically traded around 15 to 18 times forward earnings, So Coca-Cola's multiple represents a meaningful premium to that peer set. Market sentiment around Coca-Cola, as of the creation of this video, leans bullish, with the Dow reaching record highs and dividend stocks gaining investor attention, though the company faces headwinds from supply chain disruptions affecting Diet Coke availability in key markets and broader consumer spending concerns. In our view, the valuation presents a stretched setup relative to the company's growth profile and the broader alternative set available to income investors. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist of accounting signals that indicate financial health, comes in at 7 out of 9. This is a solid reading, suggesting that the underlying financial fundamentals are sound and that Coca-Cola's reported earnings quality is reasonable. The Altman Z score, a bankruptcy risk model that weighs profitability, leverage, and liquidity, registers at 4.97. This score sits well above the 3.0 threshold, placing the company in the safe zone with a low bankruptcy risk profile. On the leverage side, Coca-Cola's cash-to-debt ratio stands at 0.35, meaning the company holds roughly 35 cents of cash for every dollar of debt. This is not exceptionally high, signaling that Coca-Cola carries a meaningful debt load relative to its liquid reserves. The interest coverage ratio, which measures the company's ability to service debt from operating earnings, is 9.02 times. This means operating earnings cover interest expenses more than 9 times over, which is healthy and provides a substantial cushion. The current ratio, a measure of short-term liquidity calculated as current assets divided by current liabilities, is 1.46, above the 1.0 threshold, and indicating adequate resources to meet obligations within the next 12 months. The debt-to-equity ratio stands at 1.41, which indicates that for every dollar of shareholder equity, the company carries $1.41 of debt. This is moderate leverage, neither excessively conservative nor dangerously aggressive. Taken together, the balance sheet reflects a mature company that has been comfortable with leverage as a tool to fund growth and return cash to shareholders through dividends and buybacks. The financial foundation is stable, though Coca-Cola is not a fortress balance sheet by the standards of the most conservative investors. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 15.09%. This measures how much profit the company generates for every dollar of capital it deploys into the business. At 15%, Coca-Cola is generating returns well above the cost of capital for most investors, indicating that management is deploying capital in ways that create value. The gross margin, the percentage of revenue remaining after the cost of goods sold, stands at 61.63%. This reflects the favorable unit economics of beverage manufacturing and the pricing power that the brand commands. Moving down the income statement, the operating margin, which reflects profitability before financing and tax considerations, is 31.1%. This is exceptional and speaks to the leverage inherent in the business model once revenue scale is achieved. The net profit margin, the ultimate measure of how much of each revenue dollar falls to the bottom line, is 27.34%. This extraordinary net margin means that for every $100 of revenue, approximately $27 flows through to net income. For context, most mature industrials operate with net margins in the range of 5 to 15%. So Coca-Cola's 27% is a mark of the company's pricing power and operational efficiency. The free cash flow margin, calculated as free cash flow divided by revenue, is 11.05%. Free cash flow is the cash available to investors after the company has paid for capital expenditures needed to maintain and grow the asset base. At 11% of revenue, this is robust and supports the company's ability to pay dividends and fund repurchases. These profitability metrics paint a picture of a business with exceptional pricing power, scale advantages, and operational excellence. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 3.7% annualized, and over the past 5 years, it has accelerated slightly to 7.5%. This deceleration from the 5-year rate to the 3-year rate suggests that growth momentum may be slowing in the near term. To put this in context, the broader consumer staples sector typically grows in the 2 to 4% range during mature economic cycles, so Coca-Cola's 3.7% 3-year growth is not dramatically below peers, but certainly is not a growth engine. Book value growth, which measures the expansion of shareholder equity on a per-share basis over 3 years, is 10.3% annualized. This is interesting because it exceeds revenue growth, suggesting that the company is generating returns that are expanding the per-share equity base even as top-line growth is modest. The dividend yield, which represents the annual dividend payment as a percentage of the stock price, is 2.72% at the time of recording. For an income-focused investor, this yield provides a floor of cash return, though 2.72% is modest relative to some other dividend aristocrats and peers in the utility and real estate sectors. The growth picture for Coca-Cola is that of a mature, slow-growing business. The company is not in decline, but it is also not expanding rapidly. Management faces headwinds including shifting consumer preferences toward lower sugar beverages, competitive pressure from private label and premium brands, and limited room to expand volume in developed markets. The 5-year revenue growth figure of 7.5% may have benefited from a particular period or acquisition, while the 3-year rate of 3.7% likely represents the more normalized trajectory going forward. Now let's talk smart money. What institutional capital is actually doing with this name? 23 top-tier gurus and super investors currently hold Coca-Cola across their portfolios. Warren Buffett and Berkshire Hathaway remain the most prominent holder, with Coca-Cola representing 10.2% of Berkshire's equity portfolio with no change in position at the time of recording. This is a notable fact, as Berkshire's position has remained stable even as valuations have risen, which could suggest either conviction in the long-term thesis or that the position has simply matured to be underweighted on a relative basis. Lee Ainsley's Maverick Capital has recently added to its position, increasing holdings by 7,103.13%, which translates to a very small absolute position of 1.17% of the fund's portfolio. Yacktman Asset Management has reduced its position by 1.29%, with the stake now representing 2.06% of the fund. Christopher Bloomstrand's Semper Augustus and Jensen Investment Management both hold smaller positions with no significant activity or modest reductions. Looking at the broader institutional picture, 19.2% of 13F institutional filers are net buyers, meaning they hold more Coca-Cola than they did in the prior quarter. On a threshold of 50%, this is a bearish signal for institutional conviction. Only 19% net buying suggests that the smart money is generally indifferent or slightly selling rather than aggressively accumulating. Insider ownership among company officers and directors is very low at 0.79%, meaning that management and insiders own almost none of the company directly. Over the past 3 months, there have been 0 insider buys and 10 insider sells. This pattern of selling with no offsetting buying is a red flag. It suggests that insiders are willing to sell shares at the current price level rather than reinvest in their own company. Taken together, the smart money picture is mixed. Berkshire's continued holding is a vote of confidence, but the lack of broad institutional buying, the modest activity in hedge fund names, and the insider selling all point to ambivalence about current valuations rather than aggressive accumulation. And finally, the verdict. Let's bring it all together. On valuation, the data suggests that Coca-Cola is priced at a material premium to its intrinsic value as calculated by multiple methodologies, with a negative margin of safety and a PEG ratio that implies lofty growth expectations for a slow-growing business. On financial strength, the foundation is solid, with adequate liquidity, reasonable leverage, and strong interest coverage. Though the company is not a fortress balance sheet, on profitability, This is where Coca-Cola genuinely excels, with exceptional margins across the board, a 15% return on invested capital, and free cash flow margins that support sustained capital returns. On growth, the business is expanding at a modest 3.7% annualized rate over the trailing 3 years, well below what investors might expect given the valuation multiple. On smart money, conviction is mixed, with some legendary investors like Buffett maintaining large holdings, but with institutional buyers representing only 19% of filers and insiders actively selling rather than buying. Our interpretation of the publicly available data is that Coca-Cola represents a mature, high-quality business trading at premium valuation that leaves limited margin of safety. The company's profitability and cash generation are genuinely excellent, and the dividend yield of 2.72% combined with that profitability provides a baseline return. However, given the stretched valuation relative to growth, the lack of robust insider buying or broad institutional conviction, and the modest growth trajectory, one might argue the case for waiting for a better entry point. Current holders of the stock have a quality business, though new buyers at these prices are paying a significant premium relative to fundamental value. This setup warrants caution in our opinion. Everything in this video is our interpretation of publicly available data and not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Coca-Cola. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.